Welcome to The Explainer. I am so thrilled you're here today because, let's be real, we need to talk about the highly complex, kind of wild, and rapidly shifting landscape of the Southern Ontario real estate market as of May 2026. If you've been following the headlines lately, you know there is just a ton of noise out there. But today, we're going to cut right through all that. We are looking strictly at the raw data and the core market psychology to figure out what is genuinely happening on the ground right now for buyers, sellers, and investors.
And let's just tackle the elephant in the room right out of the gate. Is Southern Ontario finally in a buyer's market? I mean, it is the million-dollar question everyone is asking, but as we'll unpack today, the answer is, well, it's incredibly nuanced. It's really a yes-but kind of situation. We definitely aren't looking at a runaway seller's market anymore, but we're also not exactly seeing a universal buyer's paradise either. The reality? It depends entirely on where you're looking and what you're trying to buy.
So, to get to the bottom of this, here is our game plan for today. First, we'll cover the big picture for May 2026. Then, we'll do a regional breakdown to see where the real value is. After that, we're comparing condos versus detached homes, diving into buyer and seller psychology, and finally, we'll wrap up with the outlook on what comes next.
Okay, let's dive right into Section 1, the big picture for May 2026, and decoding the macro data. To really understand the current market, we've got to start with what's coming out of the Greater Toronto Area.
I want to hit you with this first major metric because it is a big one. In May 2026, GTA home sales actually jumped 6.3% year over year. And month over month, seasonally adjusted sales were up a solid 10% from April. So, spring buyers absolutely woke up and they were absorbing the available supply fast.
But here is where the tension built. At the exact same time that sales were rising, new listings fell off a cliff. They dropped sharply by almost 19% compared to the previous year. Active listings overall were also down 13.3%. Now, traditionally, you know how this works. When you have rising sales and shrinking supply, that usually signals much firmer, way more competitive conditions for sellers.
Yet, despite that significantly tighter supply, the average price actually dropped 4.6% year over year to land at $1,069,700. Think about that for a second. Stronger demand, fewer homes available, but cheaper prices. It's kind of the real estate equivalent of a glitch in the matrix. We had much stronger demand than a year earlier, but the pricing simply did not follow suit.
What's really fascinating about these numbers is how perfectly they illustrate a market that's in total transition. We've got this classic strange setup of more sales, fewer listings, but softer prices. So what does that actually mean for you? Well, it tells us that while buyers are definitely out there and active, they are highly disciplined right now and very price sensitive. Because average prices remain down year over year, buyers held on to some very meaningful negotiating power. Average days on market sat around 27 days, and properties were selling at about 98% of the asking price. So it's not deeply buyer-dominated, but it certainly isn't a broadly competitive frenzy either.
Which naturally brings us to Section 2, the regional breakdown and finding value. Because honestly, the truth is that Southern Ontario just isn't a single market story anymore. It's a highly localized, micro-market story.
The regional price directions are moving in totally different ways right now. Take a look at this contrast. On the premium side, you have corridors like Halton and York. Halton is sitting at an average of about $1.24 million, and York is at $1.15 million. These areas will always have strong long-term demand because of the lifestyle and the schools, but buyers there are way more cautious right now. They're just less willing to stretch their budgets for those past peak prices. Then, on the value side, you have highly commutable regions like Durham at $838,000 and Hamilton at $842,000. These are the practical, boots-on-the-ground regions where first-time buyers and young families are aggressively looking for space and finding a bit more negotiating room to actually get it.
And then we have the Peel region, which of course encompasses Mississauga and Brampton. I really want to zoom in on Peel specifically for a moment because it serves as this major affordability testing ground right inside the GTA. What we're seeing here is that townhomes and semi-detached homes are holding up so much better than the large detached properties. Why? Simply because they sit in a much more attainable price band. In Peel, buyers who have the flexibility to compare multiple listings and move patiently, they have a real tangible advantage right now.
Let's see how this dynamic builds outside the immediate GTA. When you dig into the months of supply across these broader areas, it's super telling. The broader Hamilton region has about 4.5 months of supply. In the real estate world, that level is a very strong indicator of a market that still leans toward buyers in quite a few pockets. Meanwhile, Waterloo Region is sitting at 3.6 months of supply, making it a bit more balanced to slightly soft. This gives buyers the luxury of choice and time, though not endless leverage. It's solid proof that value pockets absolutely exist, but you really have to read the local granular data to find them.
So, location definitely matters. But property type? That matters just as much. Let's move into Section 3, condos versus detached homes, and the major property divide we're seeing right now.
When we break down the actual sales volume, detached homes are still the absolute heavyweights here, representing almost half of all sales at 49.2%. Condo apartments accounted for roughly a quarter of the market at 23.3%, while townhomes and semis basically split the rest.
But here is the truly fascinating divide. When we compare these two major segments side by side, we are looking at two completely different affordability struggles. It's literally a tale of two markets. Detached homes with an average price of $1.35 million represent the biggest dollar value, sure, but they are also the absolute most rate-sensitive segment in the entire market. Their prices were down 4.7%. Conversely, you have condo apartments averaging around $639,000, and those were down 6.4%. While the detached home market faced massive borrowing cost hurdles, condos remained the key entry-level access point for first-time buyers. Though, to be fair, they were still heavily price-pressed due to weak pre-construction conditions and overall tight affordability.
Now, numbers and charts only tell us what is happening. To understand why it's happening, we need Section 4, buyer and seller psychology. Because at the end of the day, the human element is literally everything in real estate.
If I had to define the market sentiment of May 2026, it would be exactly this: a market in transition. It was cautious, yes, absolutely, but it was definitely less frozen than it was earlier in the year. Buyers were finally willing to act, but only, and I mean only, when they believed a home was move-in ready, fairly priced, and backed up by solid recent comparables. On the flip side, sellers were quickly learning a pretty tough lesson. Overpricing right now leads straight to slower foot traffic and much weaker offers. The market was actively, almost aggressively rewarding realism.
And what's really anchoring this psychological state? Well, it all comes back to this one fundamental truth. Interest rates still shape the market more than almost anything else out there. With the Bank of Canada holding its policy rate firm at 2.25% in late April 2026, that basic expectation of rate stability is precisely what helped those cautious, sidelined buyers feel comfortable enough to actually re-enter the market this spring.
Furthermore, the outlook from the Canada Mortgage and Housing Corporation basically reiterates this exact reality. The market right now isn't just reacting to demand, it's being heavily bottlenecked by pure affordability constraints. Until consumer confidence fully renews and affordability noticeably improves, buyers are going to remain incredibly disciplined. They just aren't budging.
So bringing all this raw data and market psychology together, what should you actually do with it? Let's move into our final section, Outlook, and what comes next for Q2 2026 and beyond.
For the rest of Q2, the overall outlook is constructive, but it is certainly not explosive. Is it a good time to buy or sell? Actually, yes, for both. But your success entirely depends on your execution strategy. Buyers, listen up. You still have leverage in the near term. Your job right now is to identify fair pricing and carefully analyze that local supply. Sellers, those old-school Wild West bidding wars are largely in the rearview mirror for now. Your advantage comes entirely from realistic pricing right out the gate and presenting a clean, compelling listing. Ultimately, relying on outdated assumptions from even a year ago will hurt you. Real expertise right now requires reading the live micro-market data.
Which leaves us with this final, really provocative question as we look toward Q3 2026. If new listings keep falling the way they have been and sales remain steady, will this increasingly tighter supply finally turn into firmer pricing? Will that gap between asking and selling prices start to narrow, pulling us away from these buyer-friendly conditions? It is the ultimate space to watch. Thank you so much for joining me on this explainer. Keep learning, keep analyzing that data, and I'll see you next time.